All right, we will go ahead and get started. Welcome, guys, to our weekly SONAR update webinar. I am Grayson Ballard. I am a SONAR account executive. I am accompanied by Zach Strickland, our market data analyst. And today we're going to dive into a couple of interesting topics. This session will be for somewhat more of the intermediate to advanced user. We'll talk a little bit of the 101s later in the broadcast. But what we're going to cover today is our newest index, which is the Outbound and Inbound Tender Volume Index. What we're going to do is discuss what it is, and we'll dive into how to utilize it and how to view this information. We're going to also do a current market analysis and see what's happening in a few of the freight markets throughout the country. And then, like I mentioned, for our beginning users, our 101 users, what we have done is we're going to click on over here to the FreightWaves SONAR website. There is a wealth. Yep, we've got a knowledge center. So when you're in SONAR, you can click on the question mark, and there is a knowledge center that will take you to our SONAR website. There is a wealth of knowledge there that you can go through weekly video updates, the exclusive insights. You can click on each one of those indexes, and it will tell you, once you click on it, what it is, who uses it, what's it going to tell me. There's videos within these that will describe, again, how to use the information. So, definitely check that out. Very informative. You can go down to the documentation. The SONAR index definitions will give you the tickers of all of the different indexes. And once you've decided on a ticker you want to see, you can type in the ticker and then the 3-digit market code that corresponds with the market you're looking for. So all of that information is there. And then the newest addition to the site, which was actually, I believe, added today, is our webinar archive. You can go in there and view all of the latest or all the archived videos, the market insights. There's some 101 intro to SONAR videos in there. So again, very informative if you're a beginning user. With that being said, I'm going to go ahead and hand it over to Zach so he can dive into our newest index.
All right. Thank you, Grayson. So we added the Outbound Tender Volume Index this week, and I know a lot of people have been asking, where's some volume numbers in here? Well, we've created an index that allows you to kind of give more weight to the more popular Outbound Tender Rejection Index. So you can actually go in and see just how much volume is impacting that tender rejection activity. So I think we've all covered I've covered the Tender Rejection Index quite a bit, but I'll go ahead and kind of give a quick overview. So the Tender Rejection Index, probably our most popular ticker symbol, if you will, OTRI is that indicator. And then you put that all with the different market granularities. USA would be the national index. So what that is saying that 18.13% of the time yesterday, carriers rejected their load tenders. So one of there's two reasons that carriers reject load tenders. One is that they don't have any available capacity to offer the shipper. And two is that they have another available option out there that might make them more willing to go that route versus the contract rate that they currently have, such as a higher spot market rate. Tender rejection index or tender rejections correlate highly with spot market activity. So the higher the number goes, the more spot market activity there tends to be. Now we have OTVI, which is a way of understanding the volume's impact on the market itself as well. So I'm going to go ahead and kind of explain a little bit of the methodology on the tender volume index. So what you see here is the USA tender volume index, and it is so the baseline. Any index that you make has a base and a base time. So the base for the tender volume index is 10,000 on March 1st, 2018. So what that means is OTVI value of 10,000 on March 1st for the overall market, which I'm going to go back here if some of you aren't familiar with our button. Let me see if I can get all the way back to March 1st. So the button that I just clicked up there was the information button. Just a little tidbit for those of you who don't know what that is. That is the basically allows you to scroll over any part of a chart, and it's going to highlight and give you the full detail of the value of that line chart on the primary index. So anything in that vertical, it'll highlight and say, so on March 29th, the OTVI for the country was 10,481. And what's that saying is, essentially, there was 4.81% more loads accepted on that day than on March 1st. So the overall market actually had more volume flowing through it on March 29th, and subsequently all of these other March dates that you see me kind of hovering over, than on March 1st itself, which is, again, something you would expect to happen in the freight markets. Now, the reason we picked March 1st is that it is kind of a midpoint. We also had enough data in most of the lanes to make a solid conclusion about it being a midpoint, but we also knew that there needed to be enough volume in some of the lanes to kind of create a good base. Of course, that there's no perfect date across the country for that to happen, but we figured it was probably one of the best ones that we have. I think most people in transportation know that freight volumes die in January, kind of slowly come back on in February, and then kind of start really moving up in March and April. And then they kind of can fluctuate in the early spring, and then they kind of spike in June, kind of slow down in July, and then towards the end of the year, you have the holiday implications and also hurricanes and things like that can really have an impact. So we really can't pick a fall value because it's just it's one of the most volatile times of the year. Lost sound. Okay. We got some, if anybody has trouble hearing, hopefully that is resolved. So like I said, March 1st tends to be a more stable time of the year, more predictable. I think we all know in the last year and a half that freight markets have been a little bit less than reliable, especially on the tender rejection side, but with capacity constraints, ELDs, hurricanes, holiday spikes, and just general driver shortage capacity issues, the market's been highly volatile over the last year and a half. March 1st still kind of behaved similarly to what it had in the past. So
I want to jump in here real quick. Zach, pull back up the OTRI USA.
Okay.
We did have a question come in. And so the user wants to know, how is the 18.13 calculated?
So that's a good question. So 18.13 is essentially, I'll explain it to you like this. So say there were 100 loads sent over from shippers on August 7th. Now, this is not a perfect example, but say 18 of those were rejected. That would be an 18% turn down rejection index. So for the country, now 100 loads is low. That's not realistic, but the amount, it's basically the amount of loads rejected over the amount of loads offered on that day. That makes sense. So it's really more of a tender rejection rate as opposed to an index. Hopefully that answers the question, you think?
Yeah, I believe so.
Cool.
And if it does not, just let us know, and we can get together after the call.
Absolutely. Yeah, you can always reach out to us going through that Knowledge Center, and then there's a contact us right here. You can send us a quick message, and we'll be sure to get back to you promptly. So back to the OTVI demonstration. So the outbound tender rejection index is useful, and like I said before, the volume aspect of it is something that we haven't had until today. So it does give a little bit more weight to what we see in the tender rejection index. And what I mean by that, I'll go ahead and actually kind of pull up the outbound tender rejection index and kind of show you what I mean. So here in June, you see that volumes, that the tender rejection indexes somewhat increase. And in May, late May, and into June, you have higher tender rejection indexes. So I want to know why. So maybe carriers are just getting better options on the spot market. Well, without looking at some of the DAT or whatever load boards or whatnot, now you can go out and see. Let's just see what kind of volume's happening in the market itself. And I'm going to break this down in kind of a more granular use case here in a minute, but I want to make sure that I drive the point home about what this is indicating. So I've got the outbound tender rejection index set up on the left side and the outbound tender volume index set up on the right side. And you can see clearly volume of loads accepted was at an 87. It was 87. It was at an 87.61 right around Memorial Day. So people aren't really accepting many loads. So volume, that means that the loads in the system are dropping off. And then early June, they continue on the same pattern, going right back up. Now they're at 107, 108. So what that means is it's 8% higher than it was on March 1st. An indication, again, there's more volume moving through the system. One of the things that I point out with the tender rejection index, it's less about the absolute value and more about the movement itself. Especially erratic spikes create a lot of you can't predict that kind of movement in the market. So when you have large amount of volume coming out all at once, carriers struggle to kind of cover the areas that need to be covered. So especially when they're imbalanced in different regions across the country. And speaking of regions across the country, I'm going to go ahead and break this down a little bit further by showing you the tender rejection index in LA and the outbound tender volume index LA. Los Angeles, one of our favorite markets to cover because the LA market itself tends to have a large impact on the rest of the country. A lot of freight movement originates out on the West Coast. Produce season, as everybody hears us talk about quite a bit, and I'm sure you're all vividly aware, does tend to create capacity constraints in the early to late spring. And LA also has the biggest port exposure in the country. A lot of freight coming over from China, and we'll talk about that also as well here in a little while. So outbound tender rejection index in LA. So I'm going to scroll on over here to May-ish period of time. You see that the tender rejection index kind of climbs up once I get my scale correct here. If I can get it to get lined up. There we go. So big spike in tender rejection, and then you have a nice little increase in tender volume. So I'm going to explain a little bit what this is right here. So you can go back, and on March 1st, the volume of accepted loads in the LA market was about 196. So that means 1.96 or almost 2% of the volume of accepted loads in the United States on March 1st is what LA outbound represents. Going into May, you're now elevating into a 2.04% of the March 1st value. And I know we're going to get the question about, well, how do I know what that means kind of absolutely? And I'm going to go through that here in a minute, so just hang tight. So you see that the volume does have an impact, and it does correlate with tender rejections. But this is not the only thing, because there's also capacity constraints in the rest of the country. So volume itself did not necessarily spike in the LA market, but that just also means that how sensitive the market is to potential load orders. So if there's 20 more load orders in a market, and there's only 3 extra trucks available in capacity, that's going to create a huge spike. So you're not going to get a lot of accepted loads. And it's going to take carriers time to move capacity into that market. So LA was a very sensitive market in May, is what this is telling me. So tender rejection is really going to be a better more telling than tender volume itself. And it's also going to tell you just how sensitive that market is to volume increases. It only went up, just a couple of percentage points versus, tender rejections. It was very sensitive. So you see a lot of spot market activity in mid-May in LA. And it wasn't on necessarily a huge spike of volume. It was really just the capacity wasn't there to cover what was coming out. Now, again, it's a big market. So you're necessarily, these guys are busy doing a lot of different things. They're not necessarily going to be focused on keeping the market itself in equilibrium. Tender volume, just one of those extra aspects that you can use to judge what the actual capacity is available in the market. So I mentioned earlier about how do I figure out, so this 201.80 that I'm hovering over right here, what does that actually mean? So that's the index itself is 10,000 on March 1st for the United States. All the markets add up to that 10,000 value on March 1st. And I want to make sure that I'm very clear here. So 201.80 is 2% or it's 2.01% of the March 1st volume. In order to get the volume as it is today, what it represents as a percentage of today, you need to go in and understand what the volume is in the country. So let's just pick today because that'll be the easiest one to kind of illustrate. So LA is at 221.27, and then the market itself is at 10,024.64. To get the total percent volume in the overall market today that LA represents, you divide 221.27 by 10,024.64, and you'll have the percentage of the market, which should be somewhere over about 2.3, 2.4% of the overall market. I hope that explanation kind of makes sense. Grayson, does it?
Yeah, so there was a question that came in. Let me kind of go over it here real quick. So okay. The user is just kind of wanting to confirm essentially the correlation between OTVI and the outbound tender reject. So the question is, if on day X, the OTVI was 10,000 and the rejection index was 25% for the same day, the assumption is that there's 40,000 total shipments in play for the day, 30,000 accepted, 10,000 rejected. So, I mean, you could make that assumption, and I'll let you dive deeper. I mean, but the 10,000 is not an actual.
No, it is not an actual number. It is, I mean, it doesn't represent the amount of actual loads. It is straight indexed. So anytime you build an index, you have a base value. Most indexes, I believe we have several of them in SONAR itself. The CAS index is one of our more popular ones. They base theirs on like a 1, for instance, base value. And that's like February 12th, 2000, or February 1st, 2012 value of 1. So whatever, say the shipments there were 100 shipments in 2012. They use 1 as their base number. So so 1.2 on the index would mean a 20% increase over the value of that day. I hope that makes sense. So this is kind of like the Dow Jones Industrial Index. Like it's got a base value, and anything moving over that base value, you divide by the base value to get the percentage increase. So it's meant to be kind of a gauge of like relativity, like what am I in relation to a certain period of time? And over time, the beginning base value, base date becomes less pertinent. And it's really more about just the movement itself, because if we did this with something like inflation, obviously you could base any year you wanted to. Typically, they tend to move the base year up intermittently to make sure that it's more relevant. But like if we based it on like the 1900s, you know, your index would be, and you based it as like a 1, you know, your value on the index would be something like 4,000. You know, it would be something astronomical. So it loses a little bit of its relational value. Ours is 10,000. So 10,000 is our base kind of number. And right now, March 1st, 2018 is our base date. And, you know, over time, it won't be necessarily that we need to know that 10,000 is the base. It's going to be really more about how it relates to where the market is today, or in that market itself as it relates to itself. So for instance, the Los Angeles market's at 221.27 with the outbound tender volume of the country being only 0.2% higher than it was in March 1st. You now know that 196 or 197 value, I believe it was, back on March 1st in LA. So LA is actually covering a lot more percentage of the overall market than it was before. And the market itself has a little bit more in it, or more accepted loads in it than it did on March 1st as well. So from that, you can glean that with LA having more percentage of the overall market and the market itself having a little bit more accepted loads in it, you actually have more accepted loads in the LA market itself overall. So that can be very valuable and very powerful when knowing what carrier sentiment is in a given market, because from there you can kind of glean capacity movements, where trucks are going, how much the freight market itself can bear in terms of volume. Like I was going through with the May example, you only had what was it, 200? Yeah, so we're at 9% or 10%. Or I shouldn't say percent in this case, but the value's at 210, which is about 13 points higher than it was on March 1st. Again, tender rejection rates skyrocketed. I guess I should pull up the OTRI LAX. And my point here is that tender rejections are actually a really solid indication. Volume is a great aspect of spot market activity, but it is not the only indicator of activity. You have capacity issues. And in a large market like Los Angeles, it is absolutely shocking to me that it only took another probably 5 to 10% more loads to completely destabilize the market itself. And I'm estimating what that number is, because I believe that the outbound tender volume for the country was probably higher in May as well. We might as well go ahead and pull it up just to see what the May values were in the overall. So May, I'm going to go over here and pull up my little information ticker. So yeah, May volumes actually up until about mid-May were underneath what they were. So they were about almost 2% lower in early May versus what they were on March 1st, which is kind of unusual. But then all of a sudden, mid-May, volume starts creeping up. We're now right before Memorial Day. You have 5% more loads than there were in the market on March 1st. And over here on LA, you have, yeah, a good bit more available there, but it's still not it's not the whole picture is the point. Hope that makes sense, Grayson. Make sure I'm clarifying this, because I know indexes are not necessarily that intuitive, but once you learn how to use them, they're very powerful in terms of understanding like movements of volume. That's what they're there for. They're there to give you this relational point to kind of understand surges and dives of volumes, and without having to understand the absolute value of a number. Like, I don't know how, is 10,000 widgets a lot? Is 2,000 widgets too little? No, but the widget index says that, you know, over time it was at 100 yesterday. Today it's at 110. So that's a 10% movement in widgets. Significant.
Yeah. Yeah. No, I believe you've covered the question.
Cool.
And if not, again, you know, reach back out to us and we can touch base after the webinar.
Absolutely.
And talk further. I did have one more question come in just about the how to compare and create a measure of, for instance, what LA's share of total market volume is. And I think just doing maybe a comparison. Could you do a relative comparison of the USA versus the LA market?
So yeah, that's a good idea. So for those of you that aren't familiar, we have this compare tool that you can click on right underneath the index. And you basically type in any of the values you want to change or you want to compare. So we're going to compare the LA volume. Now, this is where it's going to be a little difficult to compare because their scale, 10,000 is hard to compare to 200. You're going to blow your scale off. So you're not going to be able to see that very much. So what you need to do is come up here to the absolute and relative. This is going to change it to a percentage change versus the absolute value of the number. So from here, and it's also important to know that this relative scale is comparing it to this initial start point. So any change is going to be measured versus the begin point of your chart. And you can change that by simply scrolling over, and it's going to start the comparison versus whatever date you want to do. And a real easy way to do that is to come over here and say, okay, this down here is going to give you your more specific scale ability. What I mean by that is, say I wanted to compare these two indexes versus July 1st. So my start date, I click on that first by clicking July 1st. I come over here and hit August 8th, which is today. And now my scale is set from July 1st to August 8th. And I can see since July 1st, my national outbound tender volume index has moved down 7 percentage points. So my volume has actually come down about 7%, whereas the LA volume has actually increased 5%, which makes sense because LA is actually kind of seeing more volume come into it over the last 38 days or so, whereas the rest of the industry has decreased. Perfect. So yeah, so now LA is actually more, they basically have more market share in terms of accepted loads in the overall market. I hope that answers the question. But it is also, I guess I should also point out, I can do this right here. Say I wanted to compare two different markets that are not necessarily blown off by scale. Let's compare Dallas market and the Los Angeles market. And now the relational thing is cool, but I kind of want to see what it looks like on an absolute scale because they are close enough in value. Oh, I pulled up the try LAX. Let me fix that real fast. OTVI.DAL. All right. Since they are actually close and they have the same denominator, it's actually easier for me to compare these two values on an absolute scale. That's a good example of, so from this chart, for instance, I can glean the Dallas volume is kind of flat to down. The LA volume is moving up. And I just deleted it on accident by clicking on it with my phone. So, user error. I'll pull it back up. So I hope that makes sense on kind of gives you a good deep dive into the use case and understanding of the outbound tender volume index. We also offer that on the inbound side. Again, most people tend to relate to the outbound a little bit more easily just because it's like there's more like you understand what comes out of LA, the shipments, the shippers, the ports, produce, that kind of stuff. Miami, you know what kind of market that is. Now, inbound tends to be a general avoidance of a region versus like an avoidance of like capacity. If you don't have a truck in a region that you're going to, that's not that relevant. If you don't have a truck coming out of a region, available in a region you're coming out of, that's very relevant. So I need to clarify that, I think, a little bit better. I don't think I did a great job explaining that one. So inbound behavior is typically where you have kind of a weather event or a general tendency to just avoid an area because you don't have much freight coming out of it. Outbound is more commodity flow. I understand what comes out of LA. Seattle, for instance, there's no freight that comes out of Seattle most of the year. You're going to have a high inbound rejection rate relative to the outbound rejection rate. LA, you're going to be in this constant state of flux because you're going to have, that's an area that you're going to have, sometimes you're just not going to have availability going in there. But there's going to be plenty of freight movement in general in the LA area, but there's going to be a lot of truck density. So you're kind of going to be in this state of flux all the time. An example of a lane that most people don't mind going into is the Atlanta market and the Dallas market. Those tend to stay, they don't really end up in a backhaul type mentality. People generally are willing to go into Dallas and Atlanta in general. So your inbound rejection rates are going to be a lot lower than, say, a normal like head haul lane going into the Northeast or the Pacific Northwest. So inbound tender volumes can kind of give you that same kind of general idea about an area. It's going to be similar to the inbound tender rejection rate. It's just going to kind of complement it and let you know that, hey, there are accepted loads going into the area. Let's check out Seattle. So if you're going to have a big influx into one of these head haul markets, you're going to get some sort of indication right here, which is important to see. So in Seattle, in the middle of the month, you had a lot of loads going into the Seattle market. That tells me that, hey, I'm going to potentially have more capacity available in the Seattle market itself versus relative. Now, right now, what's happening in the Pacific Northwest, we're starting to get a lot of the harvests that happen in Washington. I think everybody loves Bing cherries. If you haven't had a Bing cherry, I highly recommend having a Bing cherry, unless you don't like cherries, then don't. But we're seeing a lot of, I think we saw a lot of reefer tender rejection coming out of Seattle and Spokane in the last week. Let's see here. So yeah, there's the reefer tender rejection index for the Seattle market. We're seeing this elevated level of reefer tender rejection over the last little bit. And I think Spokane was actually a better, that Yakima Valley. If those of you that aren't familiar with Washington agriculture, the Yakima Valley has it produces a large amount of produce in the summer months. And August is actually the most overlapping harvest time of year in central Washington. So you have cherries, they produced potatoes, unlike Idaho. I think they're the #2 producer of potatoes, and numerous other items that require reefer trailers. So I'm going to go ahead and pull up Spokane. There you go, Spokane. Lots of reefer tender rejections happening in the Spokane market right now. Went from 13.9 to 27. And for those of you that aren't familiar with the reefer tender rejection index, what that is it's our version of the outbound tender rejection index, but with reefer trailers. So temperature controlled vehicles, produce, things like that matter all year long, especially in the summer. When things get hot. And I believe that the West has actually had a record heat year. I think most people have heard about the California fires, but most of the West has been in a significant drought this year. I know that tends to happen just about every year, but specifically this year, it's been very hot, and reefers have been in demand for a lot of the year, specifically in the Pacific Northwest, where it does not necessarily get that hot all the time. So right now, Pacific Northwest, hot on reefer tender rejections. That being said, let's go ahead and start talking about the general market this week before we kind of start going into some more 101 kind of rehashing and just to let everybody know, I'm going to try to I'm going to try to add some 101 usage tips in here, because a lot of the questions we get, Grayson, are about how do I get value out of Sonar? Like, what do I do?
Yeah, I mean, it is a new way to view the freight markets. It's a new way to evaluate your business and how to conduct day-to-day operations by using the Sonar platform. So it is a new concept, and there's a lot of information here. There's a lot of data, so I think it just boils down to pinpointing and finding the best way to come in and start your day. And so you can highlight certain markets and I'm sure a lot of you guys have certain lanes or even certain parts of the country that you focus on. So Zach, what would be the best way for someone to get in Sonar and start their morning?
So everybody kind of has, we kind of look at this from a trucking industry type perspective. So shipper, broker, carrier, those are the main players in the trucking market as it stands today. Obviously, there's a lot of other people involved in terms of how do I, on my day-to-day, how do I use this? Some of them are going to have a higher level view, and some of them are going to have a more granular view. So from a shipper, carrier, broker perspective, down here at a lower level, if I'm looking to gain actual monetary value out of this, I am going to start with the Outbound Tender Rejection Index weekly change. As I've mentioned in the past, the weekly change numbers are going to give you the more immediate view on the map. So you don't have to go through and click, try Atlanta, try LAX, try Chicago, and figure out where's my market. So the greatest thing about this feature is that I can now go out and pinpoint those markets that are not heavily trafficked. Like, people have specific regions of the country that they specialize in. Carriers, shippers, brokers all have their own niche areas that you know more about than anybody else in the country. Well, now there's going to be, this tool kind of allows you to kind of have more insight into these more granular areas. Like, everybody's going to understand, if there's some sort of like capacity crisis in LA or Atlanta or Chicago faster than anywhere else in the country. What they won't know is there's a significant change in market dynamic in El Paso, for instance. So if I'm a regional carrier in the Southwest, and I typically avoid the El Paso market, I now look down here, wait a minute, we're not harvesting anything out of Mexico this time of year. Tomatoes, they already came through the border on, back in June. What's happening in El Paso this week? So as a regional carrier, I now have access to finding my first clue going down this path of figuring out what's going on in El Paso. And so from that, you can obviously, I guess I'm going to pull up the try ELP, and I see, yep, they're seeing a pretty good jump in tender rejections. And again, you're going to say, wait a minute, what does volume have to do with this? So now you have the option of going over here, and I can just put it right over here. You can obviously put it side by side if you want. But now we have the ability to kind of see, well, there it is. So we've had significant volume change happening in the El Paso market. So now there's a lot more volume coming out of El Paso. Now, that would be step 3 of what I would do when evaluating this. To get a better picture, I would also try to find try to see if reefer trailers have anything to do with this. There's not enough volume of reefer activity in the El Paso market is what that means. When you type in a ticker and it doesn't return any kind of value on the search bar, that means that you just simply don't have enough volume to make a significant statistical sample out of that market. So not that you're probably going to have a lot of information on the El Paso market to kind of dive down, especially if you're operating in the area. But now I need to go check out the El Paso market, see if I can figure out what commodities are happening. If I'm a broker, I'm making sure I'm charging enough for it. If I'm a carrier, I'm making sure I'm charging enough for it. But I'm also, as a carrier, thinking about how maybe I can reposition my freight, and that load that I rejected into the El Paso market last week, I now can think about potentially accepting an inbound into the El Paso market, which some carriers have already figured out. As I pull up the inbound tender rejection index into El Paso, and you can see that a lot of carriers have already figured out, I need to get trucks positioned in the El Paso area to cover this freight. And even so, there is still an elevated amount of tender rejections out of El Paso. So you can still charge a good rate for it. So one more thing I'm going to show, and this is going to be more of a generalized view, less granular, but I hope that was a good kind of use case of what I would do today, a quick hit before we have to start kind of shutting down for the week. So we've added DAT lane rates into SONAR in the last 2 weeks, and we covered that in last week's webinar pretty detailed. So a lot of these lanes have significant value with the overall market itself. If you've been reading FreightWaves, I think you've probably all seen this chart a handful of times. Los Angeles to Dallas is a fantastic lane to use. I believe it's probably the second or third largest lane out of LA, and that's not necessarily a local run. So I think Phoenix is number one, and then Dallas, and maybe there might be another one in there that's second, but it's close. Dallas is probably one of the biggest lanes in the country. Los Angeles to Dallas is. So when I'm looking at this lane, I'm getting a good idea of what's happening in kind of the West Coast market. And this is the spot rate, obviously, that DAT has come up with using their methodology, where they have cleaned this out a little bit more. It does not replace RateView. It's going to be used in the future for the settlement of freight futures, which we're not going to cover on this webinar. But it has to be a little bit more scrubbed down to ensure that it is, the number can't change. It has to be extremely reliable. So right now we see that market is essentially kind of flattened out. And we have over 5 years worth of data on this. So what I think is interesting to see is these kind of seasonal patterns that you can glean from this particular index itself. And it's not an index, it's just well, I guess it is sort of an index. But in terms of rate measurement, we can see that it's actually kind of bottomed out, and it looks like it might be ready to kind of start making a march back up. I know a lot of people on the economic front, and I'm certainly no economist, but a lot of people are worried about all the tariffs and the trade and all this impact. And I think what is important to note, having been in the industry for a long time now, supply chains do not change overnight. Just because they're talking about adding a 1-2% tariff on goods from China does not mean that all of a sudden, Walmart is going to start sourcing all of their goods from Europe tomorrow. That's going to take months, if not a year, to happen. A lot of those cost impacts have not been realized yet. So this worry over the freight market itself, kind of going back to what we saw in 2016 and 2014, there's just not, there's no indication of that right now. You can see right here, these spot market values for the Los Angeles to Dallas lane are still extremely elevated and have only been this way 3 times in the last, you can see that 5 years. Again, it doesn't mean that things won't go back, but right now we're not seeing any indication of that happening currently. And this is a really good lane to look at on a daily basis if you are a broker or shipper or carrier, to kind of glean what the overall market sentiment is. It's because it's such a highly trafficked lane.
So Zach, in talking about the fear of tariffs and such, why don't we look at the Freightos Baltic Index and see what's happening with the 40-foot containers out of China?
Yeah. So for those of you who are not familiar and maybe are just tuning into this webinar for the first time, we have the Freightos Baltic Index available in the SONAR platform. And what that is the average price per 40-foot container on the spot market from China to the North America West Coast in this instance here. We also have several other lanes, but I think everybody tends to feel China is probably one of the more interesting ones. We also have China to the North American East Coast, which you see right here. There's a list of these granularities on the index definitions that we showed you earlier. So Europe to South America West, there's all sorts of other lanes here. We feel like these are the most pertinent to what we look at. So we can see this thing is blown up in the last week again. So we saw this huge jump in July. And I know that we've seen a lot of reports of capacity kind of coming offline in the month of August in the Trans-Pacific routes. A lot of the carriers are citing, well, we're going to see volume constrictions because the tariffs are going to remove a bunch of demand. That simply has not happened yet. There's still lots of demand in the market. People are still going to Amazon and Walmart and buying their stuff. There's no indication that people are slowing down. I think I even saw a report this morning about, aren't people going to get tired of spending money? No, they're never tired of spending money. It's just, everybody's just living the dream right now with our economy, and they're waiting on the sky to fall. And you can see right here, clearly it's not falling from China just yet. Now, again, just like with trucking markets, volume is not the only thing that can move spot market rates. Some of this has to do with carrier behavior in terms of pulling capacity down. There's been several rate increases that go in here. So we might be establishing a new base like we did in the trucking market over the past year. So like I was showing you with the DAT rate a second ago, you can kind of see that we kind of, elevated to a new high, and we're not dropping below it. So what that means is the contracts, are going to create that new base level. So right here at the end of, or in the middle of February, Los Angeles was actually kind of a unique market this year where it kind of died. Unlike the rest of the country. The rest of the country kind of had this elevated activity. I think you could see that in some of the tender rejections, where LA, for instance, kind of cooled off a lot faster. And I'm going to pull up the outbound tender rejection index just to make my point real quick before we start closing down a little bit. So you see, and I'm going to compare the LA market to the OTRI USA. You can see OTRI USA kind of went up and stayed up, and the LA market kind of slowly degraded until all of a sudden produce season and the port volumes kind of picked up and sent them off on their way. So again, the LA market kind of acted a little different over the past year. So right now, freight market's still kind of cooling off, but they look like they're in a holding pattern for now. If you have SONAR, you can go in there and you can check out individual market opportunities. You don't always have to look at Atlanta, Chicago, New York, Los Angeles for potential freight opportunities. You can look all over the country in some of these lesser known markets and figure out exactly what's going on, especially if you have kind of availability to customers and shippers alike. So I think we're going to have to start kind of closing it off here for the week. Grayson, do you want to go over any?
Well, so I was going to say that we did have a question come in towards the beginning asking, if I don't have access to SONAR, how can I trial SONAR? So yeah, absolutely. The best way to do that is if you want to reach out to us, the email address is sales@freightwaves.com. You can reach us that way. You can also go to the website, and there is a request. Let Zach get it pulled up here. There is a request demo tab, and you can put in your information there, and one of our account executives will reach out to you, and we can do a quick demo and give you access to trial the SONAR platform. So if you do not currently have access, please reach out to us, and we'll gladly give you access to it.
Cool. So do we want to give people a minute to ask questions, or?
Yeah.
Okay.
If there is any
We'll go.
questions, please feel free to ask now, and we'd love to address them.
We'll go on mute for about 30 seconds to give people some time.
All right, guys, we do not have any further questions, so we'll go ahead and end today's webinar. We thank you for your time, and please get back with us next week. We'll have another webinar on Wednesday at 2 o'clock, where we will discuss potentially some more indexes that we've added if we have some by then. If not, we'll do another market review. So thank you, guys.